Good morning. Well, thank you so much for coming to hear about the A Committee. A is for awesome. The Life and Annuities Committee. It's a little bit a tough act to follow an astronaut speaking this morning, but our goal really is to be very informal and informative. And so I am happy to be joined on the stage by some of the best practitioners in insurance you will ever find. I am Judy French. I'm the director for the State of Ohio Insurance Department, and I chair the A Committee. We have two vice chairs, Tennessee, Commissioner Carter Lawrence, and Doug Omen, who's here today from Iowa. We also have our two NAIC contacts are Jennifer Cook and Julie Matthews. And so we have just this terrific team focusing on life insurance issues. So I have a few goals for today, just to get those out up front. The first is just to give you a quick intro into all things A Committee and the work that we do. We want to introduce you to a few of our priorities. We have 4 of them that we want to cover. And as we discuss those priorities, we want to give you different perspectives. In particular, we want to contrast the way that I might be thinking about an A Committee issue as a director who reports to the governor in Ohio with the way that a commissioner from another state or even somebody from my own department might be thinking about that issue. And the key takeaway, the key thing that we really want you to hear today is that we do all bring different perspectives. Each of those perspectives is valuable. Each is necessary. We all serve different bosses. We serve different constituencies. And the best way for us to consider any issue that confronts us, whether that's on A Committee or anything else, is for us to be aware of those different perspectives, to take them into consideration, and to learn of those different perspectives as early as possible. So if you are somebody who's working on an issue at a working group level, know that I might have a different perspective on that issue, and I want to find out about it just as early as possible. So just for our benefit here, just by a show of hands, I'm going to run through some different areas, and I just want to kind of see who's in our audience today. If you're in risk management, if you can raise a hand. Product regulation, maybe actuarial services, okay? Legal, I like lawyers, welcome. Communications, okay? Consumer services, those, and administration. And any that I have missed, that you don't feel like you fell into any of those categories. Well, thank you very much for being here. We appreciate each of you. I'm going to turn things over quickly to Doug, and if you would like to say hello.
Oh, there is no button. Thank you, Kevin. Yeah, first of all, I'm Commissioner Doug Omen. Thank you. I do serve as vice chair of this group, and I think Director French mentioned something that relates to the work we all do and does relate to the work of the astronaut, and that is, recognizing that we all have a part, we all have an issue that maybe we own, but we collectively own the responsibility of state regulation. And I think you'll find that at the commissioner level. So even if Director French and I don't agree on some of the details, we agree certainly on the common mission. And within an office, that is true as well. So again, I look forward to a good discussion today about some of the things going on with the A Committee.
Great, thank you, Doug. We are going to ask that you hold questions until the end, just to make those a bit more manageable. And we are going to keep an eye on the clock. I know that for those of you needing credit, you need to stay here for 50 minutes, and we're going to keep you here for 50 minutes. So the first thing is just to give you kind of a quick intro into the A Committee, life insurance and annuities. Our mission is pretty straightforward. We, number one, consider issues relating to life insurance and annuities. And number two, we review new life insurance products. Now, within the A Committee, we do have 2 working groups. We've got the Accelerated Underwriting Working Group, and their role is to consider the use of external data and data analytics and accelerated life insurance underwriting, including the consideration of the ongoing work of the Life Actuarial Task Force, which we'll get to in a minute, and if appropriate, to draft guidance. Well, I'm happy to say that they've accomplished that mission as of the last national meeting, so we will likely be dissolving that working group, which was led by Nathan Hodak of Wisconsin. The second working group, which you'll also hear a little bit more about today, is the Annuity Suitability Working Group. And the mission of that working group is to consider how to promote greater uniformity in the adoption of a model regulation around annuity suitability across NAIC jurisdictions. So more about that in a moment. But we also monitor the activities of the Life Actuarial Task Force. Now, we lovingly call that LATIF, and so that's a term that I hope to share with all of you, that you will now understand when somebody just refers to LATIF. That is the Life Actuarial Task Force, and it's really an entity all its own. Texas is the chair, Virginia is the vice chair. It has 22 members. They have 6 subgroups with independent membership. Their mission is to identify, investigate, and develop solutions to actuarial problems in the life insurance industry. They work to keep reserve reporting and other actuarial-related requirements current, and that includes principle-based reserving and other requirements in the valuation manual, actuarial guidelines, and recommendations for appropriate actuarial reporting and blanks. Now, that, for those outside the actuarial field, may not sound like a lot. It is a huge lift. And I just want to give a shout out to those states who are involved in LATIF and those subgroups. This is a group that works really hard at what they do. They have their day jobs, and then they also have LATIF. They arrive a day and a half early to national meetings. Their meetings are a day and a half long, and they do really important work that's at the foundation of a lot of the work that we do. So as we shift into talking about some of those priorities, I'd like to begin with a couple of them that arise out of LATIF's work. Now, I'm going to take a seat. We're going to keep this conversation very informal, and we'll hear from others on the panel. But first, I do want to have the members of our panel, before we get into that discussion, introduce themselves.
Yes, I'm Pete Weber. I'm the life actuary at the Ohio Department.
I'm Kevin Clark. I'm the Chief Accounting and Reinsurance Specialist at the Iowa Insurance Division.
And I'm Mike Janacek. I'm the Chief Actuary at the Iowa Insurance Division.
And before I sit down, let me just say that the brain power on this table right now is pretty high. The first topic that we want to talk about in terms of our priorities is one that does come out of LATIF, and it involves the economic scenario generator. Now, there are some people who like to call it the generator of economic scenarios, or GOES. I think that's a verb. I just don't do it. I can't use the word GOES, but that's I've lost that battle. So Iowa is going to take the lead as we talk about GOES and how it fits into the regulatory structure, but it's something that we'll hear a lot about over the next year or so. So I think, Mike, I think you're going to take it away.
Thank you. Now, real quick, we'll just start off with a little bit of background about the scenario generator. First off, why is it important? And I'm going to hit that real simple. It's a very key component in all of the asset adequacy analysis that the life insurance companies have to do. Whether it's the actual asset adequacy analysis itself, or if it's in reserve calculations, you can find it for the life products in VM22, VAs, variable annuities, in VM21, that's in the valuation manual, section 20 or 21. Shorthand is VM20 or VM21. And it's also used in capital calculations for variable annuities and in a variety of C3 calculations. So that's why the scenario generator is important. What brought us to this point where it's worthy of talking about even further is the fact that about a half dozen years ago, give or take, there was a broad recognition amongst the regulators that the scenario generator we were using at that time did not really have a low for long scenario that it was encompassing. What it did have was not low enough, and what it did have was not long enough. And if you think back to, half dozen years ago, sometime pre-COVID, 2017, 2018, 2019, that was a very well-known risk. A lot of the analysts and examiners were very keen to that because a lot of GPSs and IPSs would speak to the greatest risks companies had, and one of those was a continued low for long. The actuaries are aware of it as well. That was something that needed to be documented quite well in asset adequacy analysis and elsewhere. The problem we had was that the scenario generator we were using at that time had been provided to us as an industry and as regulators out of a very significant and great volunteer effort from the American Academy of Actuaries. They had developed the scenario generator, they had maintained it and updated it, they'd recommend changes from time to time to it, but it was not quite staying low enough, long enough from the regulator's perspective. Upon inquiry about that, the Academy did let us know that they would not be able to put forth the significant effort required to change the generator to meet the desires that the regulators felt was necessary for low for long. They could maintain it as it was, but it had been a long project just to get it to that spot. It had been used for many years, and the effort to completely overhaul it was going to be too much. So we put out an RFP process, a request for proposal through the NEIC. After bids were submitted, after we considered the various options, we chose Conning and their scenario generator. They are an expert in that world, and that's what we needed. There were other experts in that world who also sent in proposals, but that's the one we went with. So where are we at this point? Well, we've got their scenario generator, and we're in that phase that I would generally call calibration. Okay, we're trying to set the scenario generator up to create the type of scenarios that we want it to use, and that we want it to create for companies to use in their solvency. That is a very heavy lift. We want the scenarios to not only be lower and longer than they had been, but we also want a little bit more volatility around interest rates, perhaps a little bit more volatility around equity returns. We also want to represent high rates and high long periods, and we want to have low returns from equities at the time we've got some low interest rates, just to make sure that it's getting the right set of scenarios. Let me stop for a minute and just mention, when we're talking about scenario sets, we're talking about roughly 10,000 scenarios over time, projected out for up to 100 years, okay? So a 100-year period as to what could happen is just one, and we've got 10,000 of them. So there's room for a lot of variation, but we weren't seeing enough of it in what we were having provided for years. So that was the big reason for the change. Certainly, anytime you're looking to change the requirements and possibly make something like scenario tests and asset adequacy analysis a little more pertinent and have a little more bite, one of the things that needs to happen is we really need to consider, are companies being stressed enough? Some companies are going to hear that and have opinions as to whether or not they are or are not. And there's going to be others at a certain element that are just going to say, if this looks like it's going to raise capital requirements or reserves, we need to fight it, push back, slow down. So there's certainly motivation on both sides of this to improve it and have more low for long and other scenarios. And there's also people who are very concerned as to what this will do to the products they can provide to consumers. And I think as regulators, we're trying to balance that as best we can. One thing I do want to point out, we're talking about creating 10,000 scenarios. We're not trying to predict anything, okay? This is not a prediction. We're not trying to estimate what we think the stock market's going to do or what treasuries or corporate bonds or anything else is going to do. We are trying to create a set of scenarios that companies need to use just so that they can ensure to us that they've got a reasonable level of solvency. That's all we're trying to get. We're trying to get a reasonable set of scenarios that can be used to demonstrate sufficiency of capital and reserves. So with that, if I get very current, as of today, we have one company left who's going to present to us results from their field test. That's going to happen hopefully this week. It's being worked on to get that scheduled. Our next steps are then to summarize all of the feedback we've gotten on the latest field test. When I say summarize, it's going to be completely anonymized, of course, because all of this was done in regulator-only session. but we did get a couple dozen companies who gave us great detailed feedback. And we're going to get that summarized, presented on a public call, and then the regulators are going to have to determine how close we are to having a good set of calibration criteria for the scenario generator. And that's a big step, that's an important step, and we'll have to do that in a public call to figure out where we stand. So a vague description of next steps. And the first one is that this will be effective for companies no sooner than January 1 of 26, okay? That's the soonest this can be in place. But we do need to continue to progress and get this field test wrapped up because there's another field test for another section of the valuation manual that needs to get started. That's valuation manual section 22 or VM 22 for annuities that are not variable annuities. They have their own field test going on. So that's where we are at this point. So I don't know if anybody else has anything that they wanted to add, Pete, perhaps?
Yeah, just kind of my 2 cents, Mike, is looking at this project over the last 6-8 years, really, just how difficult and technical it has been. And it's something that's not necessarily in the actuary's wheelhouse. It's in LATIF because that's where reserves are calculated and these capital calculations are kind of managed. But you know, we're relying on other experts, and that's kind of why, you know, big reason why Conning was engaged is because they are the experts in this area. So it is a little interesting project in that you're really kind of, you know, relying on you know, an outside vendor where we had been doing this sort of thing internally. So, but yeah, I think you nailed almost everything.
My involvement in the generator project has been very different. I'm a lawyer by training. I do not speak actuary. And it is such, as they've said, Mike and Pete said, that it's a very, very technical project. But the feedback that I was getting was at a very different level, where we had industry coming in and in some ways trying to control the narrative about what was happening with the project. And it was in Kansas City at the national meeting a couple of years ago, where I got pulled into a meeting where some of the industry members were angry about the direction and kind of wanted to take us back even before the RFP and the selection of Conning. And so much of what I've had to deal with as the chair and the leadership in A committee have had to deal with is really around a narrative about what we were doing, why we were doing it, and that we were still remaining open-minded about changes that might need to be made. And so to Mike's credit, as the chair of the working group, a lot of communication has gone into just communicating with industry to say, here are the deadlines, here's exactly what's happening, we're still open to your feedback. And I've been on those meetings. Mike does a great job as a chair of those meetings to be very welcoming of comments. I think that kindness goes an awful long way in those kinds of situations where people are arguing about 10,000 different financial scenarios. And so this has probably been the most drama-filled project I have been involved in as part of NEIC and being the director. So it just points out again the difference in perspectives and the things that we have to deal with, where you've got industry complaining to me, but the work is really being done at a very technical level. So the more I can know and understand about what's happening at the technical level, the better I can communicate with industry to explain, here's what we're doing. And one of the things that we did, I think, to kind of counteract the narrative that was happening was at one of the national meetings, we did kind of a level set where we had Mike and Rachel Hempel from Texas just give a background on kind of what Mike was talking about. Here's where we were, here's where we are now, here's what we think is going to happen, but really to help us as a committee and as regulators shape the narrative and keep it out of the drama-filled arena. Anything else? Well, speaking of drama, the next priority that we wanted to talk about is private equity. It is certainly not unique to A committee. You'll also hear a lot about it in E committee, but it's something that because of the life insurance industry, it's become a very hot topic. So I think, Kevin, I think you're going to lead us on the discussion about what does that even mean and why are we concerned about it?
Yeah. So maybe first, just to kind of level set, who here has heard about private equity and insurance, whether you encounter it in your role or have read articles or seen a headline that references this? That's what I thought. Pretty much everybody, because it has been, a very hot topic for the last several years. So I thought it might be good to take a kind of step back and kind of explain the background and evolution and how we got here. And kind of, I think a key part of this is how this trend has gotten much more broad than the term private equity likely implies. And so this really started, a little over 10 years ago with the entrance of Apollo into the insurance market with its acquisition of an interest in Athene. And there was a lot of concern, I think, when that first occurred, and it might be helpful here to give a background on what private equity actually is for what those initial concerns were. Which is, generally the private equity business model has been they raise third-party capital to start funds. Those funds then acquire, companies, portfolio companies, with the intention of increasing the value of those holdings and then eventually monetizing that through resale to get the external investors their money back plus an attractive return. So the concern initially is pretty logical, which is that one, is the insurance company in this scenario the investor, the external investor, or is it the investee? So if it's the investee, the concern was that, well, the private equity company is just acquiring this stake for a temporary period in order to improve returns and then is looking for an exit. And the concern there is, given that life insurance is such a long-term commitment to policyholders, that those objectives may not align well with policyholder interests. In the alternative, if instead the insurance companies to be the investor, the concern was that, well, they're going to load up and invest heavily in private equity investments, which are, by their nature, a pretty risky investment. And concern was, is this an appropriate type of investment to back life insurance obligations? So that was, the logical kind of initial concern. But what it's really evolved to has actually not been that case. So for example, these relationships have tended to be permanent. And the reason that you can see that this would be an attractive thing for a private equity company is they're in the business of managing assets for external investors. Well, life insurers have very large balance sheets with a lot of capital to invest, and that is permanent capital because it's going to be there for the long term to support policyholder obligations. And so it's an attractive thing for an asset manager to get into, is to be able to permanently manage this very stable asset base. Whereas in the private equity example that I mentioned, usually that capital comes in and then they're going to want it out. So there's huge benefit to the asset manager, but there's also benefits to the insurance company. Mike mentioned a little bit the low for long environment. I think one of the catalysts for causing this trend was that for many decades, several decades, interest rates just kept going down. And so for a lot of these long-term blocks of business, that made it very difficult to continue earning a spread on those policyholder obligations because they were written at times where there was higher embedded guarantees in those products, and their spread was compressed over time due to the low interest rates. And so what insurance companies really needed, before this latest increase in interest rates was higher yielding investments. And so that's where the asset manager came in with different type of investing strategy wasn't necessarily private equity, but what it has really turned into is more private credit. So the asset managers have largely built out these large origination platforms where they could do all types of different lending, and then the insurance company is able to back their long-term liabilities with these long-term lending obligations. And so that's kind of been the evolution. So the initial concern didn't end up being kind of the primary concern. Where the concern has come is more on the complexity of a lot of these securitized lending products and whether our system contemplates that. So from a capital perspective, historically, insurance companies have invested primarily in like corporate bonds, more traditional types of bonds. And so the question has been, now that insurance companies are investing in more complex securitized products, does our capital framework contemplate that? And it doesn't, because the bond factors were developed solely based off of corporate data. So one of the big things that E-Committee is looking at right now is to examine the capital factors that apply for these types of products and make sure that they adequately contemplate the risk. But a key part of this is we're seeing this trend far more widely than just private equity owned companies. This is a trend that is affecting the entire industry, no matter, I guess, what the ownership structure is. It was certainly started by the private equity entrants, but after seeing kind of the success of that model, it's really evolved to essentially encompass, the entire industry, moving towards more of this private credit type of investing. The other area you might be wondering, how does this tie into A-Committee? And that's where I'm going to focus now. Is one of the other key activities that started along with this trend has been more heavily using cross-border reinsurance. So one of the other benefits that, I guess, entrance of more private equity players into this market has had is that because of that low for long environment and some of the problems that traditional companies have had with their back books that have become not very profitable, is that they had a very difficult time raising capital, new capital into the industry. And so for a number of years, there was almost no capital coming in and a lot of capital fleeing the industry, which has a number of implications. But what it really opened the door for was somebody to come in with capital raising expertise, and that's where the private equity markets really came into place. And so starting, probably 5 to 7 years ago, there started being this trend towards using something called sidecars, where essentially a reinsurer is set up with third-party investor capital to come in and be able to expand the capacity of the insurance company to write more business than they would otherwise be able to with the capital they have available. And it really has allowed the industry to grow. But what that has caused is most of these sidecars are set up in other non-US jurisdictions. And there's a reason for that. One is that, the primary one is that it's very advantageous from a tax perspective. A lot of this capital is coming in from foreign markets, and it's difficult for foreign investors to invest in a US company because they would then become subject to US withholding tax. So a lot of that capital has been raised in jurisdictions like Bermuda. And so one of the efforts then to tie this back to A-Committee has been, what do we need to understand as it relates to reinsurance going to other jurisdictions? And in particular, how do their reserving and capital models compare to the US? Is there regulatory arbitrage going on? There's just been a lot of questions and risks that have been raised by this trend, which again is much more broad than just private equity at this point. It's virtually nearly every insurer at this point has some kind of sidecar at this point to help with their capital capacity. And so, Pete, I think I'll probably kick it over to you to kind of describe then how LATIF has been addressing this question.
Yeah, thanks, Kevin. This, you kind of hit it with these sidecars and these offshore reinsurers kind of, assuming the business and holding these maybe more complicated assets, more riskier assets offshore, kind of out of the line of sight of U.S. regulators. One thing that U.S. regulators have for their U.S. insurers is asset adequacy testing. It's a requirement that uses the generator, or can use the generator, to sort of project your business, to project your liabilities and your assets, to provide an opinion that your assets are adequate, that all the liabilities as they come due out in the future, you've got assets in place and the timing's right to be able to defease those. And when a U.S. insurer cedes it offshore, that becomes a little more difficult because the offshore is holding the assets, and even the U.S. insurer, may not have a good line of sight into actually what's supporting those. So, LATIF kind of observed this in a couple steps. One is they kind of wanted to get a better handle on the assets that are backing, at least onshore insurance companies with these more complex assets, and they implemented an actuarial guideline 53 to provide more documentation, and that's been in place for a couple of years. We're coming up on the third year of that, and that's been very helpful. But they're now in the process of attempting to get their eyesight into, well, what are the assets, and are they going to be available when the claims come due, be it death or most likely surrender or annuity kind of surrenders. It's really more of a fixed annuity phenomenon at this point, but it could be expanding, certainly. Are those assets going to be available to pay the claims? And, of particular note is that this structure hasn't really been stressed yet. Like you said, it was, 10 years ago, and while we were in a very low environment then, it really wasn't terribly volatile. So what will happen when we have, sort of a market event or a recession or something really stressing the economy, like maybe we saw in 2008? How are these assets values, and how is their availability to be liquidated and pay the claims? So LATIF is working on an actuarial guideline to try to get some information there, and it's kind of a very difficult question because they're up against some things. One is there's reciprocal jurisdictions and other kind of things put into place that limit just how much U.S. regulators can do in this area. The other thing is I think from those enough who are really paying attention, there may be some, you're trying to get at where is the risk. You don't want to just scope in all of these treaties that go offshore or, go to other, jurisdictions and say, well, we need to focus on those, you need to do a bunch of extra work. Because, just because it may be a very large treaty, it could be observed that there's really not a ton of risk here. We feel like there's safe assets. Those are, we're not as concerned there. But you may have, smaller, mid-sized treaties where there is a lot of risk. Or, there could be, other kind of combinations of that. So a really difficult question in this part of the process is, where is the risk? And we call that the scope. What are we going to scope in? What kind of treaties, what kind of situations are we scoping in to this guideline to do this additional testing? And that's kind of where we are now. I can say at the last national meeting, LATIF exposed a potential guideline, but they also exposed several questions with that. And one of the first ones was, well, how are we going to identify which treaties and which, arrangements that we want to really pull in and focus on? How do we really get at where the risk is in these? And that's, and I will say, even just last week, there was a call of LATIF where they kind of pulled that back a little bit, and rather than trying to draft a scope, they were trying to get comments. Again, they exposed this guideline until the next meeting, but they also set up kind of checkpoints along the way to discuss a couple things. One of them is the scope. Another one is, there's other elements that they're going to be trying to get feedback on early, so they're not just kind of waiting till the meeting to talk about this. But the scope, they kind of decided, as they were working on it, that it was kind of hard to sort of draft where this was. So what they're going to do is, and I'm not going to call it a field test, they're just going to do sort of reaching out to individual companies and get kind of, how they view this, kind of get feedback from some of the big players in this area and see sort of what are features of their business or their investments that would indicate, hey, there is more risk here than in one where we don't, have those same concerns. So that work is kind of working. And like I said, we really just haven't had a real stress model. So the idea is that this guideline would then require testing of those offshore assets, again, scope down to where we feel there's the most risk, to see just how bad could it get. Are those assets available to be liquidated when they're really needed? And I think that's kind of a synopsis of where LATIF is on that in this topic.
Doug, do you have a perspective? So now you've heard the very technical, down in the weeds discussion about private equity. My involvement has been at a much higher level, and it is second in drama only to the generator project. You can imagine, if you think very broadly about the introduction of private equity into the insurance industry, that there are companies out there who feel very differently about it. And so if you have in mind, let's call them an old school company, very conservative in their investments, in their management, in their portfolio, they're just a more conservative company. They are very suspicious of private equity and very concerned about any policies that we might put in place that give even more opportunities for private equity. On the other hand, you have companies who have a different mindset about that. They are less conservative. They are more focused on higher returns for the industry. They think that there could be higher returns and, in their view, better success for the industry. And so in Ohio, what I was seeing was those two views coming to a head, to the point where I was getting a phone call from the Ohio Chamber of Commerce. I was getting calls and letters given, to my governor. It became a very high-profile question around asset adequacy, but at the base of that was really the concern around private equity. And in that instance, what I had to do as a director was at least understand as much about the technical piece of it that was necessary to communicate to my governor about private equity, or to communicate to companies on both sides of the question. Here's why we are voting the way that we are voting, whether in A committee or on LATIF or in E committee. And it became, I think, probably the ugliest discussion that I have seen in my 3.5 years, almost more of a negative political campaign where you had a grainy picture of a regulator and kind of a narrative that was out there. It became something that we needed to talk to our congressional delegation about. And so it is yet another example where, yes, the technical work is ongoing and it's very important. It's critical to what we do as regulators, but I'm in a different kind of discussion where we're talking about broader policies around private equity. So I'm happy to say that the narrative has become a bit better, a little less dramatic, but it is one area where you will find states have different views, the companies within those states have different views, and in Ohio it was a very loud discussion. I think Iowa's different.
Yeah, I would just add to that. The NAIC as an organization really, I think, excels at building consensus. And I think even when you get into issues like this where there's maybe some states that have different levels of experience and different histories in that regard, and frankly, different companies, that discussion can take on, did you use the word ugly? Or, I guess I would just offer that because the NAIC is really designed to bring people together to have open discussions, I think actually, the outcomes that we generally achieve are really favorable to the public. They're favorable to the policyholders that we're protecting. And I think this is yet one more example of that, where you have to just be patient with the process. In Iowa, I can't think of at least one circumstance where I'm driving to work, and I don't know if this happens in other states, where I'm driving to work and I'm driving down Florida Drive, and I look off to my right and there's a billboard that was taken out because some organization was opposing the new relationship between what historically I would describe as private equity, but more investment management, and their ownership or their new ownership with one of the Iowa companies. It's not very often that insurance in that way makes the billboards, that is transactions that are coming to me before, in a Form A hearing, but nevertheless, yeah, they can be pretty excited about those types of things.
Yeah. And I should clarify, those are really good points, Doug, and I should clarify, when I used the word ugly and some of the drama, that was coming from outside NAIC and outside the regulators, and we were having to try to control the narrative in a way that was not negative, that it was about collaboration and getting to a result without that sort of negative view. But yeah, my colleagues at NAIC are among the most diplomatic. Well, we are now at 10 minutes. And we've got two more topics to talk about. The first is annuity suitability, and then we're going to talk about illustrations. So I think, Doug, do you want to talk about annuity suitability?
I'm going to try to, I think I told the director I could do this in 5 minutes. I think I have 2 minutes now, but I'm not sure there's any subject out there that you can make a career on, but I've tried to make a career out of this topic. I started in Missouri working in the Securities Commissioner's office in 2000, and I started working on equity indexed annuities, as they were then known, in 2001. So I really have been at this for quite a long time. I think probably what I want to do for this audience is just bring it forward to the work that has been recently done. And if you look at the discussions that have gone on with the Department of Labor, they'll often describe their regulatory efforts as the fiduciary rule. In all frankness, suitability and even now our regulatory best interest rules, they are a very close cousin to fiduciary. Fiduciary is a judicially created concept. It deals with those obligations of obedience and loyalty, which you can kind of think of knowing your customer, because in 275, we're trying to create that relationship between the producer and the customer. And that would be a fiduciary obligation of obedience and loyalty. In fiduciary law, there's a requirement of care. We put that into 275 as well. And then, again, we added some requirements surrounding documentation. But the point of all is that that obligation of care is sort of central to the rule, and that is the reasonable expectation of diligence in making a good, thoughtful recommendation. So you have to know your customer, you have to know the options, and I think, again, under our NAIC regulation, you have to know your customer, but also know what are the available options within your licensed authority, and then do a very good job of matching the product that you believe is the best of those, or a good option in that choice, and then do whatever it is you can do in order to document that. So that's the basic framework of 275. I would say that in terms of the fiduciary rule that the Department of Labor has tried to put out, I would make the comment that the first one that they put out, I think, was in 2010. They went to court, lost. They tried again in 2017, which is why it is one of the reasons we reopened 275 and reactivated the Annuity Suitability Working Group in order to try to, again, improve and address some of the concerns that were being raised in the Department of Labor's 2017 rule. They were enjoined there as well. And now we are here again. They have tried, I guess you could call this DOL, Fiduciary Rule 3.0, but literally we're almost 20 years later. Is it 20 years? No, 14 years later, where they're trying yet again. And I expect under the recent Supreme Court action in January, the Loper decision, that it's, in my view, again, don't go to the bank on this, but I expect they're going to be unsuccessful yet again. What is, setting aside whatever it is the feds do, it's really important that we as regulators do our part in protecting consumers. These are highly complex products, what we now call fixed index annuities. They do fit an important role in retirement security, but at the same time, they've got to be reasonably connected with the objectives of the person who's making that decision. And they're only going to get that benefit if the producer who's making that placed business has their loyalty to the customer and less so to their own financial arrangement. And so in our rule, we have done that. I'm not going to go through all the details. Frankly, I'd like to, but time doesn't allow me to go through all the details. But I would just, again, for those in this audience, really appreciate how important it is as we move forward that we have some consistency in enforcement. So related to that, what is now a little over a year and a half ago, the Market Action Working Group started an implementation review of all companies, that is the top 25 carriers. That has moved forward pretty well. I think there's a number of states that have been very much involved in that effort. We're really, after having gone through all the top 25 carrier policies and procedures and giving them critique and feedback, I think we're in a pretty good place to move into what I would describe as phase 2 of that review. And that will involve it'll involve testing of whether or not, how it is that the companies are basically administering their responsibilities of supervision. One last topic in that process, we have discovered, and frankly we saw this under the old rule as well, but there's a lot of distribution that goes through the security side of the house. And what I mean by that is for people that are registered securities agents and they operate within the supervision of a broker-dealer, there's a lot of companies that are successfully offering these annuity products through that distribution. And it's an important part, as I said earlier, for a retirement plan. But under the safe harbor, we allow the insurance company to rely on the broker-dealer to do that work if the broker-dealer has set up their business rules in such a manner as to apply their obligations under the securities best interest rules to the fixed indexed annuities that are within that basket of options. And what we have found is the companies, frankly, it's been a little bit of a blind reliance. And so we expect we're going to see a lot more activity in making sure that the insurance companies fulfill those obligations. I've just finalize that by saying, because I've worked on this so long, I'm not sure there is any difference between how I look at this and how my staff looks at this, because I probably tell them a lot how to think about this. But I think the reality is that what we've discovered is that we can do the best we can on annuity best interest, but ultimately what we're discovering is there are issues surrounding illustrations and how that plays into making sure that the objectives, which is a best interest component, is matching the expectations. That is, the objectives of the consumer is going to match the expectations that are being created by these illustrations. So anyway, I would close with that. I know we're really short of time, but
no, that's a
probably
perfect
move into
segue.
illustrations.
Pete, how about illustrations in 2 minutes?
I can try to do that. I was going to give you a sort of a what are illustrations and how does universal life work, but you're spared from all that because we don't have time. Just suffice to say that an important part of the sales process is to provide an illustration to a consumer so that they can understand how the product works. And particularly with, we're not talking about term insurance or fixed premium whole life, we're talking about universal life products, be they variable or fixed or indexed in particular, is where these, where I'm going to speak to, is that the interest credited is such a crucial component of how successful insurance contract owner is going to be as far as identifying what premium you can put into the policy, whereon you get interest credits to what remains in there so that it can, grow to be able to pay for itself down the line. And you might imagine, if an insurer can provide an illustration that has as high an interest rate as possible, you're going to have a lower premium to be successful. So going back about 10 years ago, it was observed in the market that there was some very overly optimistic crediting rates being displayed. And this was a situation where you had both sides of the industry kind of battling with each other, because more traditional writers were skeptical and being kind of forced out of the market when these more aggressive illustrators were selling their product. So LATIF got involved, and there's a model in place that talks about, hey, here's the maximum illustrated rate you can use, and it's in a model, so it's got, it's a bit vague. LATIF drafted a guideline called AG 49 years ago that helped kind of put some limitations on that. Well, fast forward a few years, and industry got more creative and decided, well, if we have these bonuses or if we had these multipliers, we can do things to our products to really kind of juice up that rate and still be compliant with AG 49. LATIF address that, and we have AG 49A, and then even just a couple years ago, there was something else identified where they tweaked 49A to kind of address that. So it is a bit of a whack-a-mole situation with the way the regulation and the guideline is set up. But a good answer is, over the last year, LATIF has been reviewing, they had a small group of regulators review the illustrations of the largest writers. So the answer coming out of that was, yeah, the guideline seems to be doing what it intended. We aren't seeing the really egregious, very high illustrated rates. And that's working in that sense. They identified a couple things, and one of them was, to the extent that companies weren't illustrating with a high rate, there was another section where they said, oh, by the way, if you had invested in this index 20 years ago, you really would have earned a very high rate. Again, not using it as an illustration, but like additional information about how how profitable their might be. Yep. So I'll kind of wrap it up there, and know that there's maybe a little more work coming on that one.
Yeah, that was the illustration speed round. But you will, within a committee, we're hearing a lot from consumer representatives about the illustrations issue, and I think taking a really comprehensive approach, trying to learn as much as we can about the industry before taking any action. We are at a time. I think we've gotten you to your 50 minutes, so that was one of the goals. But I think anybody here would be willing to take questions. If you want to come on up and ask a question, we're very happy to answer any questions that you have. Thank you very much for your interest in a committee. We do, at all of the national meetings, we always have a presentation or two just on broad topics relating to life insurance and annuities, and we invite you to join us for one of those. So thank you again. Come on up for questions.